Hey everyone, welcome back to The Explainer. Pull up a chair because today we are hitting the whiteboard and mapping out the absolute fundamentals of investing. In our last module, we established a golden rule. Buying a stock means buying business ownership. It is so easy to just look at a ticker symbol blinking red or green on a screen and frankly, treat the stock market like a casino, just hoping your color hits. But that brings up a massive, highly practical question. Before you put your hard-earned money into buying a share, how do you actually understand how that specific business makes its money? Who's paying them? How much? And is this whole operation actually built to last? Well, today we're going to walk through the investor's blueprint so you can definitively decode literally any company out there. Here's our quick agenda for today's explainer. First, business versus revenue models. Second, Lynch's 6 categories. Third, Fisher's Scuttlebutt method. Fourth, we'll dive into some real Indian market case studies. And fifth, we'll finish up with the ultimate crayon test.
Section 1. Business versus revenue models. Understanding the foundation.
Okay, let's dive right into this. To be a smart investor, you need to know exactly what you're looking at. And it really all starts right here. First up, the business model. Think of this as the broad, big-picture strategy of the operation. A business model is simply a company's overarching way of making money. When you're analyzing a stock, you absolutely need to answer 3 basic questions. Who exactly is the customer? What specific product or service is being sold? And broadly, how does the money come in? If you can't answer those 3 basic questions, you have absolutely no business buying the stock, period. Take Asian Paints, for example. Sure, they manufacture paint, but they sell it to a massive network of thousands of dealers, and then those dealers are the ones who sell it to you. That overarching structure, that's the broad what and who of the operation.
But knowing that broad strategy just isn't enough. And that brings us to the revenue model. This is the much more specific, mechanical side of the cash flow. It answers exactly when and exactly how the actual money hits the company's bank account. If the business model is the entire car, well, the revenue model is the specific engine under the hood actually powering it forward. Think about the stark contrast between these 2 concepts. On one hand, you have your overarching strategy. On the other, the actual gears and mechanisms of cash. You really have to ask yourself, is the cash flow a one-off transaction, like Zomato taking a commission cut of your dinner order? Or is it a subscription, like a fixed monthly fee for Netflix? Maybe it's a massive one-time sale, like Maruti selling a car. Or is it a recurring service, like your monthly Bharti Airtel phone bill? Here's a golden insight for you. Wall Street and Dalal Street both absolutely love predictability. The most successful companies usually have a highly predictable revenue model. A recurring revenue model is almost always viewed by investors as way superior to a one-time sale. Why? Because predictability drastically lowers risk, and lower risk means the market is going to happily pay a much higher valuation premium for that company.
Section 2. Peter Lynch's 6 categories. Bucketing your investments.
So once you understand how a company makes its money, you need to know what kind of company it is. That brings us to the legendary investor Peter Lynch. Lynch famously divided all companies into 6 specific buckets. Let's rapidly map these out using some familiar Indian stocks. First up, slow growers. These are established, massive companies like ITC or Coal India that you hold mostly for their reliable dividends. Second, stalwarts. Large, stable giants growing at a predictable 10 to 15% like HDFC Bank or Hindustan Unilever. Third, fast growers. Smaller or mid-cap aggressive companies growing at 20 to 30% like older Bajaj Finance or DMart. Fourth, cyclicals. Companies whose profits rise and fall directly with the broader economy like Tata Steel or major automakers. Fifth, turnarounds. Fallen companies attempting a dramatic comeback like Yes Bank or BHL. And sixth, asset plays. Companies sitting on hidden assets like prime real estate that the market just isn't valuing properly like certain PSU stocks. Listen to me on this one. Before you do any deep financial math, you must first decide which of these 6 buckets a stock actually belongs in. You don't expect a slow grower to double your money in a year, and you absolutely do not buy a fast grower expecting a massive, stable dividend payout.
Moving on to Section 3, Fisher's Scuttlebutt method, ground truth investing.
Now that we've bucketed our company, how do we find out if they're actually any good at what they do? Enter Philip Fisher, an absolute pioneer of growth investing. He started his own firm way back in 1931 and notoriously bought Motorola stock in 1955 when it was just a radio manufacturer, and he held on to it until the day he died in 2004. If you need a credibility check on Fisher, just consider this. Warren Buffett himself, arguably the greatest investor of all time, describes his own investing style as being 85% Benjamin Graham and 15% Philip Fisher. Buffett actively praises Fisher's writing, calling his landmark work a very, very good book. Let me tell you, when Warren Buffett tells you someone's framework is good, you write it down.
Fisher's most legendary contribution to investing is the Scuttlebutt method. Scuttlebutt basically means listening to the grapevine. It is the active, intentional process of stepping entirely away from the polished, heavily edited, PR-approved corporate financial reports and going out into the real world to gather raw, ground-level information about a company. Put simply, don't trust the spreadsheet, trust the street.
Here's how you do it. Step 1, talk to customers. Are they actually satisfied with the product, or are they actively looking for alternatives? Step 2, ask competitors. What do they honestly think is this company's biggest weakness? Step 3, ask suppliers. Does this company actually pay their bills on time, or are they constantly squeezing their vendors? Step 4, talk to the employees. Is the culture toxic, or is it thriving? Because if management is cutting corners, believe me, the employees know it long before it ever hits a quarterly earnings report. If you're looking at Asian paints, just go ask any local paint dealer in your neighborhood which brand sells the most. Most of them are going to tell you it's Asian paints. That is ground truth. And today, we have it so easy you can do digital scuttlebutt right from your couch. Go to Glassdoor. If the employees are complaining about a toxic culture and cheap management, that is a massive red flag the balance sheet won't ever show you. Jump into Reddit forums, watch raw customer feedback on YouTube, read Quora discussions, dig up the dirt and dig up the praise.
Section 4. Indian Market Case Studies. The Whiteboard Application.
All right, theory is great, but application is absolutely everything. Let's walk through some examples together on the whiteboard to see these concepts in action. Think about Asian Paints again. The business is manufacturing paint. Their revenue model is B2C through a massive network of over 70,000 dealers. And their key moat? That unbreachable distribution network. A new competitor simply cannot replicate 70,000 dealer relationships overnight. It gives them such incredible pricing power that they can hike prices slightly every single year, and customers barely even blink. Now consider DMart. Their business is discount retail. Their revenue model relies on razor-thin profit margins, but incredibly high volume. What makes them unique, their moat, is that they actually own their store real estate, so they pay absolutely zero rent, allowing them to buy in massive bulk and heavily undercut competitors on price. It is literally perfectly engineered for the Indian middle-class bargain hunter.
Take Bajaj Finance, a consumer lending NBFC. Their business model is beautifully simple. Borrow money at a cheap rate and lend it to retail customers at a much higher rate. That spread between the two is their profit. Historically, they've maintained a net interest margin spread of around 7 to 8%. It just shows how elegantly simple and highly profitable a lending business can be when executed well. But remember our scuttlebutt rule? Your primary ground truth task here is figuring out if they are lending to people who will actually pay them back, constantly checking for the risk of loan defaults.
And finally, think about Zomato. They run a food delivery and dining business. Their revenue comes from commissions on every single order, plus recurring subscription fees from their premium programs. But what really drives them is the holy grail of tech, the two-sided network effect. As they get more restaurants on the app, more users sign up. Because there are more users, they place more orders. Because there are more orders, even more restaurants want to join the platform. The model literally feeds itself, creating a moat that is incredibly difficult for any new startup competitor to cross.
And finally, Section 5. The Ultimate Crayon Test. Keep it simple.
To wrap up this explainer, I want to bring it all back to Peter Lynch for one final, absolutely non-negotiable rule. You've looked at the business model, the revenue model, the bucket, and you've done your scuttlebutt. But before you buy, you have to pass this test. Lynch famously said, "Don't invest in any idea you can't illustrate with a crayon." If a company's business or revenue model is so incredibly complicated that it requires a PhD in advanced mathematics just to understand how cash actually enters the bank account, walk away. Seriously, complexity is very often a massive smokescreen used by bad management to hide bad debt or failing fundamentals. It is a glaring red flag for retail investors.
So I'm going to leave you with this provocative challenge. Can you explain the stock you want to buy to a 10-year-old? Can you sit down and say, Beta, Asian Paints is a paint company that has 70,000 dealers across India who sell their paint. Boom, done. Or, Beta, Reliance Jio runs a mobile network and takes $300 every month from its users to let them use the internet. Done. If you are stumbling over your words trying to explain the core cash flow to a child, you don't understand the business well enough to risk your hard-earned money on it. Think about your own portfolio right now. How many of your stocks actually pass the crayon test? That wraps up our blueprint on business and revenue models. But remember, a fantastic company in a terrible industry is still going to suffer. So how do we evaluate the broader battlefield? Join me in our next explainer where we're going to unpack Porter's 5 forces for industry analysis. Until then, stay focused, do your scuttlebutt, and keep learning.